Today, I want to talk about three things, which are the missing steps in the trader's journey. First is stop loss, second is long and short tool, then is position size calculation. But before that, welcome to CryptoPi, the hub for transforming trading using technical analysis and risk management. Thanks to the viewers who saw the first two videos. I hope you liked it, and I would be happy to get some feedback on what we can discuss in the future videos. Now, coming back to the charts. There are three things which I often notice during my discussion with other traders or people who are investing. They hardly or ever mention about stop loss. And definitely they don't use, or they have very seldom use, long and short tool, which we discussed briefly in video 2. And lastly, the position size calculation is very important while trading. Perhaps to a certain degree also while investing for long term, but if someone is trading on day-to-day basis or on a lower time frame such as 5 minutes or 1 hour or 4 hour, it's really good to know how to calculate a position size. Alright, now going to the first step called stop loss. Last time we took an example for identifying the trend at this particular date, which was around October 16th, where I clicked on this icon, which is an icon for long position. If you click here, if you would say that I'm taking a long position at this point, my profit goes up until 19% or 35% with stop at 20%. This basically means that if the price, instead of going in the direction of the long side, which is upwards, if it would have taken another path, which is to start going downwards, then my position would be closed, or I would close my position when I'm at loss of 20%. Now imagine if it is 100 euros, which I took entry at using 100 euros or $100, then when I would lose 20% of my entry, that is when I will reach at 80 euros or $80, then I would have closed my position with a loss of 20 of unit or 20 fiat, whichever country you are in. Now instead, if I would have kept my trade and let it win up until 33%, then I would have gained 33% on the 100 fiat, which is $100 or euros. How do we identify stop loss? Now, in this case, it's by default, it takes some value and plots it. If I take a short position here, you would see, if I click here, it provides some default 13%, 14%, which is making sure that the risk, which is the red part, versus the reward in this short position is 1. Now I want to know, when I take a position, where exactly is my stop loss? And one of the ways where we can identify stop loss is by identifying swing points. There are plenty of indicators provided by the community, and here you would search swing point, then you will see lots and lots of swing point indicators. Now instead, I have already selected one of them. I have adopted it from the community. Let's see which one is that. To understand what a swing point is, first we have to identify where the trend is. And when the trend ends, that is the point when a value is created, and that value becomes the swing point. In this case, let us take example of trend starting from here, going all the way up here, up until this point. And we see that on 17th December, the price reversed for about 2 weeks or 3 weeks. The swing point is only identified at a later stage. When the price is trending, one would not be able to identify where the swing point is, because only after knowing that the trend has reversed from this point, we would be able to understand that, okay, on December 16th was the swing point. Same goes for the swing point in the opposite direction. If we take the trend, the downtrend which started from here up until this point, we know that on 10th of March or 11th of March, the price started reversing. And later on, it went further down after 26th March up until 8th of April. These indicators, they help already to identify, so we do not have to do manual work in identifying which points are considered as swing points. What essentially this indicator does is it looks back in the high, low, close, and open in the last 14 candles, and then checks whether the value is eligible for a swing high. A swing high is when the swing point is on the higher side and the candle before and after has the value lower than the high of the swing high. Same goes for swing low, where the low of the candle is lower than the two adjacent candles. Okay, that is how we can identify swing points. Let's keep this on. Now comes the long and short tool. This I introduced already very shortly in the last video, but let's look at that again. Let's take the example of 16th October again, and now we have this swing low here, which is marked by these green dots. If I go on to this date, which is 14th October, and I decide to take a long position here. Now, how do I decide? That is another chapter. Let's assume that our technical analysis, our technical indicators tell us that it is a good place to take an entry for a long position. I enter at the close of 13th October, and now I have to define where would be my stop loss, because by default this is approximately 1-to-1. If I take this swing low, I will bring the level over here slightly below the marked points. However, like I said, we only get to know swing points at a later stage. Here the length which is defined is 14, so it looks back 14 bars. If I do replay, you will notice that there is no swing low at this point. It is only detected when the candle moves 14 bars. You see, after 14 candles are printed or are shown, you will see that a swing point is detected. However, I would like to take a trade at this point. So the easiest thing to do here is not to consider this swing point, because we will be detecting or identifying it manually, but rather take the swing point which is before that. So in this case, we would move our stop loss slightly before the swing point over here. And then we let the candle move on, and we see that our long position is going into profit. Now, same is applicable for the short position. Imagine I would like to take a trade over here. After I see this downtrend going and starting, I would like to take a short position somewhere here. Again, this is purely based on what the technical analysis or technical indicator would tell us. And like I said, the indicator, discussion of indicator is a completely different chapter. All right, so this is a short position. By default, we both have both the bands on the same percentage. Now let's click on replay again and see which one is our swing point. So here we clearly see that the swing point which was on this date, 20th January, is gone. It's no longer detected because 14 candles hasn't been passed. And instead, we see a swing point over here. However, we also notice that this particular candle had a value above this swing point. So even though it is detected on this level, on this value, it's best to not place it at this value, but rather the high which is above the high which was printed by the swing point. You can, of course, make it like this, though it is a bit more risky to trade it when we know that there is a price action which already reached or which had already crossed the last swing point. You can always, while trading, we can always move our stop loss. So it is better to be safe at this point rather than sorry when the stop loss is hit. And we can see that the trade goes towards the short position, or it goes there, but we have now defined stop loss. So the swing points are pretty simple to identify where one can place stop loss. So this covers basically the first topic. Now the other one is very important, that is position size calculation. What does that mean? Every time, if I would have taken trade with all my amount which is in my portfolio, and imagine my stop loss is hit by 10%, 12%, I would probably have maybe 10 trades before I lose all the money. And this is exactly what one should avoid. And often, if I'm a beginner or this was a mistake or a concept which I did not understand very clearly, because in plenty of videos I heard you should only risk 1% of your portfolio. And it wasn't clear, how do I compute this 1% of my portfolio? Then at one point during search among various tutorials, various books, this is the formula which I came across. At the moment, I do not have the reference, but I will later add it in the description. So let's say that I have 1,000 fiat. Fiat here is dollar or euro or rupee or anything which you would be trading with. And 1,000 is the amount which I would be having for a particular trade, including if I'm taking the leverage. Now, a good number to take the risk is somewhere between 1 to 2%. In this example, let's say we take 1% risk per trade. So 1% of this trading amount is the risk which we are taking. So if I have $1,000 in my account, if I'm taking 1% risk, so if my trade goes against my analysis, if I'm taking a long trade and instead of going upwards, instead of becoming bullish, the market goes bearish or it goes in the opposite direction, I will lose $10. And those $10 will be lost when my stop loss is hit. Now, how do I calculate stop loss? We just saw an example, let's say, based on the swing points. There are various strategies. Swing point is one of the strategies. For the moment, let us assume that our strategy, swing point, or any other technical indicator tells us that our stop loss is at this particular value, which is 2%. Now, my position size, after considering the risk per trade and the stop loss and how much trading amount I wish to invest for that particular trade will be computed based on this formula. So position size is risk taken, which is this one. That is the 1% of the trading amount, divided by stop loss in percentage. So that is 2%. So if we put all these values, what our position size comes out to be is $500. Now, there is one thing which is also in this long shot tool. It's not just identifying the position here, but if you double click on this one, you can simply create a nice formula based Excel sheet where you identify what is your stop loss based on what is your entry price, what is your stop level. And once you have your stop loss, once you define how much risk one wishes to take, one can easily compute position size per trade. Now, the second topic, which is very much connected to the position size, is we already saw risk to reward. It is often said that it's good to have a risk to reward ratio of at least 1, because every time my technical analysis tells me, all right, I have to take a trade and my indicator is 51% correct, for example, then I still make more money than the money I lose. At the end of the day, trading is basically, the goal should be that we lose less money than the amount which we win. If the technical indicator, let's say its accuracy is not 51%, but the accuracy reduces to 40%, then we need to be sure that our risk to reward is higher than 1. That is, it can be 1.5, 2. There is another chart which computes the accuracy of the technical indicator or accuracy of the position, taking the position indicator versus the reward. And this balance has to be made pretty carefully. And once we know our risk to reward ratio, that shows us that I have made more money by winning the trades rather than losing the money by taking a particular trade. That would be all for today's session. Next one, I would like to discuss more about different indicators which help us identifying when a particular trend starts, when a particular trend ends, when is the reversal, when the consolidation. So basically looking into various indicators, which are, some of them are pretty basic, some of them are slightly advanced, but it's good to have a nice overview of it. Thanks a lot for viewing this video, and if you like the content, write down in the comments what you like it, and if there are certain topics which I can discuss in the next video, also please write it down in the comments. Thank you, and see you in the next one. Bye-bye.